All right, welcome to the deep dive. Today we're going deep, and I mean deep, into Forex.
Ooh, 4X. Sounds intense.
It is. It's the foreign exchange market, the biggest financial market in the world. Bigger than stocks, bigger than crypto combined.
Wow, I knew it was big, but bigger than stocks and crypto. That's saying something.
Yeah, we're talking trillions, like over $6 trillion changing hands every single day.
Trillions. It's hard to even wrap your head around numbers that big, but how does that affect, the average person?
Think about it. Everything you buy, from that bag of coffee to a plane ticket for your next trip, has been touched by Forex. The prices of goods and services, how much your vacation costs, it all comes back to the exchange rates between different currencies.
Okay, I see. So it's this massive global system humming along behind the scenes.
Exactly. But the thing is, Forex can seem super complicated. Like you need a PhD in finance just to understand what's going on. All those charts and graphs, the constant fluctuations.
Yeah, it can definitely feel overwhelming, especially for someone who's just starting out.
That's why we're here. In this deep dive, we're breaking down Forex trading in 2025, making it accessible and understandable. No jargon, just the essential stuff.
Love it. Cutting through the noise.
By the end of this, you'll have a solid grasp of the basic concepts, how this market actually works, and who knows, you might even feel confident enough to dip your toes in and try a few trades yourself.
Now that would be empowering. Knowledge is power, right?
Absolutely. And to do this right, we've done our homework. We've dug into a bunch of beginner guides and in-depth tutorials from some really smart Forex traders on YouTube.
Oh yeah, like who?
People like Matt Donlevy, he runs Photon Trading, FaxLX, there's Wise Trade, Vidollar, GFAX, Booming Bulls, Trade with Pat. We've also got insights from educational platforms like Investopedia, FX Academy, and Forex.com US.
Nice, a good mix of perspectives.
Each of those sources had something unique to offer, different ways of looking at the market, different strategies.
Uh-huh.
Our job is to pull out those key takeaways, those golden nuggets of wisdom, to give you a well-rounded view of Forex trading in 2025.
Sounds like a plan. Let's dive in.
Okay, first things first. Let's answer the fundamental question. What exactly is the Forex market?
Well, at its core, the Forex market, it's basically a giant global marketplace where people, institutions, businesses, they exchange one country's currency for another.
Right. Think of it like this. You're traveling from, say, the U.S. to Europe. You go to a currency exchange kiosk at the airport, and you swap your U.S. dollars for euros, right?
Yeah, I've done that plenty of times. Gotta have those euros for that delicious Italian pasta.
Exactly. Well, that's a tiny example of what's happening constantly in the Forex market, just on a massive scale.
Got it. So who are the players in this huge market? It can't just be tourists exchanging currency.
You're right. It's way more than just tourists. You've got individual retail traders, like maybe some of our listeners thinking about getting into Forex. You've got giant institutional investors, banks managing international transactions, hedge funds looking for opportunities, and even big companies who need to pay suppliers or get paid by customers in different countries.
Wow, so it's a really diverse mix of players.
Yeah, a global ecosystem of currency exchange. And here's the thing about Forex trading. You always trade currencies in pairs. You're always buying one currency and selling another at the same time.
Why is that? Why not just trade a single currency?
Because the value of a currency is always relative to another currency. You can't just say the US dollar is worth this much in a vacuum. It's always the US dollar is worth this much compared to the euro or compared to the Japanese yen and so on.
So you're making a bet on which currency in the pair will strengthen or weaken relative to the other.
Exactly. If you think the euro will rise against the US dollar, you'd buy the USD pair.
Okay, so it's all about these pairs. Are there specific pairs that are good to start with?
Most of the sources we looked at recommend starting with the major currency pairs, the ones with the highest trading volume and liquidity.
Liquidity meaning it's easy to buy and sell quickly, right?
Exactly. That usually means tighter spreads. We'll get to that term in a
Oh,
minute.
good to know.
So the major 8 currencies are the US dollar, the euro, the British pound, the Japanese yen, the Canadian dollar, the Aussie dollar, the Swiss franc, and the New Zealand dollar.
That sounds like a lot to keep track of. Do I need to know the ins and outs of every single currency?
Not necessarily, especially when starting out. Like you said, stick to the majors first. You'll see these currencies abbreviated with 3-letter codes. For example, USD for the US dollar, EUR for the euro, and so on. It's pretty intuitive once you get used to it.
Okay, codes make sense. What about these exotic currencies I've heard about?
Ah, yes. Exotic currencies are from, well, Less major economies, they can fluctuate a lot more, which can mean bigger profits but also bigger risks.
So probably not the best place for a newbie to start.
Probably not. They're less liquid, spreads can be wider, and they can be a bit unpredictable. Better to get comfortable with the majors first.
Makes sense. So we've got currency pairs. What else do I need to know to even start thinking about trading?
Let's talk about some key terms you're going to run into.
Hit me with them.
First up, pips. A pip is the smallest unit of price movement in a currency pair. For most pairs, it's 0.00001. So if the Euro USD moves from 1.1050 to 1.1051, that's 1 pip.
Okay, so it's like the smallest tick on the price chart.
Exactly. Then there are lots. A lot is a standardized unit of trade volume. There are standard lots, mini lots, and micro lots. Micro lots are the smallest, which is what most of the sources recommend starting with.
Why start so small?
Because it minimizes your risk. You're basically controlling a smaller amount of currency, so your potential losses are smaller too. A micro lot without leverage is usually equivalent to treating around $1,000 worth of the base currency.
Makes sense. You don't want to go all in when you're just learning the ropes.
No, every time you trade, your broker charges a small fee called the spread. It's the difference between the buying price, the ask, and the selling price, the bid, of a currency pair.
So it's like the cost of doing business with the broker.
Pretty much. Spreads can vary depending on the currency pair, market volatility, and the broker itself.
Got it. So you want to look for brokers with tight spreads?
Definitely. Now, here's where things can get a little tricky. Leverage. This lets you control a larger trading position than the money you actually have in your account. For example, with 50-to-1 leverage, you could control a $50,000 position with just $1,000 in your account.
Wow, 50 times leverage. So my profits could be 50 times bigger. That sounds almost too good to be true.
It can amplify your profits, yes, but it also amplifies your losses. That's the big catch.
Oh, right. High risk, high reward.
Exactly. And that's where margin comes in. Margin is the amount of money your broker sets aside in your account to cover potential losses on your leveraged trades.
So it's like a safety net for the broker.
Kind of. If your losses exceed your margin, you might get a margin call, and your trades could be automatically closed to prevent further losses.
Okay, this is starting to sound a bit scary. How do I prevent blowing up my account with all this leverage?
2 words, risk management. And part of that is using essential tools like stop loss and take profit orders.
What are those?
A stop loss order is an instruction you set to automatically close your trade if the price moves against you by a certain amount. It's like setting a safety limit to prevent catastrophic losses. And a take profit order does the opposite. It automatically closes your trade when the price reaches your desired profit level, locking in your gains.
Okay, so they're automated safeguards to help manage risk. And I guess the last two terms are pretty straightforward, long buy and short sell.
You got it. Going long or buying means you're betting the base currency in a pair will rise in value. Going short or selling means you think it'll fall.
Got it. So you can profit whether the market goes up or down.
Exactly. Now let's talk about trading styles. Some people are in and out of trades super fast, while others hold positions for weeks, even months.
I imagine that affects your whole approach to trading.
Big time. The main trading styles are scalping, day trading, swing trading, and position trading.
Okay, break those down for me.
Scalping is the most intense. Scalpers try to grab tiny profits from very small price movements, holding trades for seconds or minutes. They make a lot of trades, hoping those small wins add up.
Sounds stressful, like you're constantly glued to the charts.
It definitely is.
Mm-hmm.
Then there's day trading. As the name suggests, day traders open and close all their trades within the same day, holding positions for a few hours at most. This style is popular with people who have a day job and can only trade for a few hours each day.
More manageable than scalping, I guess.
Definitely. Then we have swing trading. Swing traders hold trades for a few days to a few weeks, riding those bigger swings in the market. This gives them more time to analyze and be selective with their trades.
I like the sound of that. Less pressure to constantly make decisions.
Finally, there's position trading, the most hands-off style. Position traders might hold trades for months or even years, focusing on those big long-term market trends. They're almost like long-term investors rather than active traders.
Interesting. So lots of different ways to approach the market.
Tons. Now let's talk about the actual steps to get started with Forex trading.
Hit me.
Every single source we looked at stressed one thing above all else:
Huh?
education. You've got to learn the basics before risking a single penny.
But there's so much information out there. Where do you even start?
Luckily, there are tons of great free resources to get you started. Places like Baby Pips, FX Academy, and Investopedia all offer structured courses that cover everything from the absolute basics to more advanced concepts. And they're free, no excuses.
Free is always good. But what about actual real money trading?
Before you do that, you need a broker. A broker is the company that gives you access to the Forex market and lets you execute trades. Choosing a good broker is crucial.
What should you look for?
First and foremost, make sure they are regulated by a reputable financial authority. That gives you some protection if things go wrong. Also, check out what other markets they offer. Do they just offer Forex? Or do they also have stocks, crypto, or other assets you might be interested in? Look at their fees, especially the spreads, and make sure their trading platform is user-friendly and secure.
Any specific brokers you'd recommend?
Well, FactSelect's mentioned LQH Markets is a good option. And Trade with Pat often mentions the broker he uses and provides a link in his videos. But do your own research too. There are plenty of good brokers out there.
Okay, so you've got your education, you've chosen a broker. What's the next step? Do you just jump right into live trading?
Absolutely not. Before you touch real money, you need to practice with a demo account. Almost every broker offers them. It's basically a simulated trading account with virtual money.
So you can get a feel for how it all works without risking your savings.
Exactly. You can test strategies, learn the platform, and get comfortable with the whole process. Plus, when you set up your demo account, use a virtual balance that's close to what you plan to trade with in real life. That way, you get a more realistic sense of potential profits and losses.
Makes sense. What about trading platforms? What are the go-to platforms these days?
The two most popular are MetaTrader 4,
Hmm.
MT4, and MetaTrader 5, MT5. They're used by tons of brokers and have a ton of features for charting, analysis, and executing trades. Frieslex had a funny analogy. He said MT4 is like the iPhone 11, while MT5 is like the iPhone 15.
So both good, but one's a little newer and fancier.
Right. You also want to check out TradingView. It's a great platform for charting and analysis. It has a ton of indicators, tools, and even position size calculators to help you manage risk. You can't directly execute trades on TradingView with most brokers, but it's a great complement to your main trading platform.
And what about the Miss Xbook position size calculator and Forex Factory that some of the YouTubers mentioned?
The MythXBook Position Size Calculator is a super helpful tool for figuring out how much to risk on each trade based on your account size and your stop-loss level. Forex Factory is a website where you can track economic news and events that might affect currency prices. But remember, FactSelect's caution that news can be unpredictable, so don't rely on it too heavily.
So now I've learned, I've picked a broker, I've practiced on a demo account, I know my platforms and tools. What am I missing?
You need a trading plan. This is your roadmap to navigating the Forex market. It outlines your risk management rules, your trading strategies, and your financial goals.
So it's basically a set of rules to keep you on track and help you make rational decisions.
Exactly. And risk management is a huge part of that. Matt Donlevy had a great point. He said, as a Forex trader, you're basically a professional risk manager first and foremost.
Interesting way to look at it.
Your primary goal is to protect your capital and stay in the game long enough for your profitable trades to outweigh your losses. Think of it like a casino.
Yeah.
They don't win every hand, but they manage their risks so well that they always come out on top in the long run.
That's a good analogy. So what are the best practices for effective risk management?
Never risk more than you can afford to lose. That's rule number one. You should only be trading with money that, if it all disappeared tomorrow, wouldn't drastically affect your life.
Okay, so no rent money on Forex.
Definitely not.
Yeah.
And always calculate your position size carefully. You shouldn't be risking more than 1 to 2% of your total account balance on any single trade. Use stop-loss orders religiously on every single trade. It's your insurance policy against catastrophic losses.
So important.
Also, avoid overtrading, especially after a loss. Don't get emotional and try to win it all back in one go. Take your time, stick to your plan, and let the probabilities play out in your favor over the long term.
It sounds like emotional discipline is a big part of this.
Absolutely. Now, let's move on to how to actually analyze the market and find trading opportunities. There are two main schools of thought: technical analysis and fundamental analysis.
Tell me more.
Technical analysis involves studying charts and price patterns to identify potential trading setups. You look for things like support and resistance levels, trend lines, candlestick patterns, and various technical indicators to get an idea of where the price might go next.
So you're basically looking for clues in the historical price data.
Exactly. And then there's fundamental analysis, which focuses on the underlying economic and political factors that can influence a currency's value. Things like interest rates, inflation, economic growth, and political stability can all impact exchange rates. You have to keep up with the news and understand the big picture to be a good fundamental analyst.
So it's like being an economist and a news junkie all rolled into one.
In a way, yes.
Yeah.
But don't worry, you don't need a PhD in economics to get started. Some of the YouTubers we mentioned advocate for simpler approaches that focus more on price action.
Price action? What's that?
It's basically analyzing how the price is actually moving on the chart, looking for specific patterns and signals that indicate potential trading opportunities. Trade with Pat, for example, focuses heavily on simple price action strategies, like trading breakouts from established trend lines or identifying support and resistance levels.
So you don't necessarily need all the fancy indicators and tools to be a successful trader.
Not necessarily. The simpler, the better, in many cases.
We also heard about supply and demand zones and market structure and time frame analysis and fair value gaps. How do all those fit in?
Supply and demand zones are areas on the chart where there was a big imbalance between buyers and sellers. Those areas can act as support or resistance in the future. Market structure is all about identifying the overall trend of the market. Matt Donlevy says that you can look at the sequence of highs and lows on the chart to determine if the market is trending up, down, or sideways. He even had a cool insight about how a move on a higher time frame, like the daily chart, might look like a trend on a lower time frame, like the 15-minute chart. Time frame analysis can help you see the bigger picture and find precise entry points for your trades. Fair value gaps are gaps on the chart where the price jumped quickly, and booming bulls has strategies based on how those gaps tend to get filled over time.
Wow, so many different ways to look at the market. It's amazing how many strategies and concepts there are.
It is. But don't get overwhelmed. Focus on one or two concepts at a time. Master those, and then expand your knowledge gradually.
Good advice. Now, what about these prop firms I keep hearing about?
Prop firms. They're pretty interesting. Basically, they're companies that give you money to trade with, their capital, not yours. But to get access to that money, you have to pass an evaluation. It usually involves trading on a demo account and proving you can make consistent profits without risking too much.
So it's like an audition for traders.
Yeah, kind of. If you pass, they give you a funded account, sometimes with a lot of money, like $100,000 or even more. You trade with their money, and if you're profitable, you keep a big chunk of the profits, usually around 80 to 90%.
Wow, that sounds amazing. So I could potentially trade with a huge account without risking my own money.
You could, but there are challenges, of course. Passing the evaluations can be tough, and there are usually rules you have to follow, like maximum drawdown limits. But prop firms can be a great way to leverage your skills and earn a significant income without having a ton of capital to start with.
It sounds like something to look into for sure.
Now, one more thing I want to touch on. It's something a lot of experienced traders say is just as important as your technical skills, maybe even more important, trading psychology.
Oh yeah, the mental game. I've heard it's crucial.
It is. Trading can be very emotional, especially when real money is on the line. You have to learn to manage your fear and greed, to avoid making impulsive decisions, and to stick to your plan even when things get tough.
Easier said than done, I'm sure. What are some tips for mastering that mental side of trading?
The YouTubers we studied had some great advice. First, avoid revenge trading. It's that urge to jump back into the market after a loss and try to win it all back immediately that almost always leads to more losses. Second, don't let a few wins go to your head. Overconfidence can make you careless and take unnecessary risks.
Okay, so stay grounded and avoid extremes.
Right. Another great tip from booming bulls is to set specific trading hours and stick to them. Don't be glued to the charts all day long. Take breaks, step away, and give your mind a rest. Otherwise, you can get burned out and make emotional decisions.
And Booming Bulls also said something about being realistic, not daydreaming about becoming a millionaire overnight.
Absolutely. Approach Forex trading as a profession, a skill that you need to learn and develop over time. There will be ups and downs, wins and losses. The key is to stay disciplined, manage your risk, and continuously learn and improve.
So it's a marathon, not a sprint.
Exactly. Now let's wrap things up by walking through what it actually looks like to execute a trade on a platform.
Okay, I'm ready to see how all these pieces come together.
So let's say you've done your analysis, you've found a potential trade setup, and you've got a plan. You know what currency pair you want to trade, your entry point, your stop loss level, and your take profit level.
Right, I'm all set up, ready to click the buy button.
Not so fast. First, you need to determine your position size using a calculator like the MIFEX book one. This takes into account your account size, your risk tolerance, and your stop loss distance.
Right, got to manage that risk.
Once you've got your position size, you go to your trading platform like MetaTrader, find your currency pair, and enter your order. You'll click Buy if you're going long or Sell if you're going short.
Buy or sell, got it.
You'll likely see a small negative balance right away due to the spread, but don't worry, that's normal. Then you monitor your trade, adjust your stop loss or take profit if necessary, and wait for either your stop loss or take profit to hit or close the trade manually if you decide to.
Wow, it sounds more straightforward now that we've broken it all down step by step.
It really is. The key is to start slow, learn the basics, and practice on a demo account until you feel comfortable.
So what are the biggest takeaways here? What should someone who's completely new to Forex keep in mind?
Three things: education, a solid trading plan, and unwavering risk management. If you prioritize those three things, you'll be well on your way to success in Forex trading.
And remember, there are tons of free resources available to help you learn. Platforms like Baby Pips, FX Academy, and Investopedia are great starting points.
Absolutely. And don't underestimate the power of practicing on a demo account. It's a risk-free way to gain valuable experience and build confidence.
So if you're ready to explore the world of Forex, there's no better time to start than today.
That's right. Take advantage of the resources out there, be patient, stay disciplined, and you never know. You might just surprise yourself with what you can achieve.
And who knows, maybe one day you'll be sharing your own Forex trading wisdom on YouTube.
You never know. All right, that brings us to the end of this Forex deep dive. We hope you found it insightful and, most importantly, empowering. Thanks for joining us.